Hello, and thank you for joining me for this week's Financial Plan for Canadian Business Owners. I'm Jason Pereira, and today I have Rachel Wasserman, business lawyer and economic policy fellow, who is starting a new law firm called Wasserman Law. And I brought her on today to specifically talk about the realities of private equity, what it means to sell your business to a private equity firm, and what that can mean long term for the business, both the good and the bad. So, Rachel, thanks for joining me today.
Thanks for having me.
So, Rachel Wasserman, tell us a little about yourself.
Not a usual career path for a lawyer. I started my career in business at Unilever, understanding how the consumer packaged goods industry worked. Got a little bored and wanted to change, and my parents had always told me I'd be a good lawyer, but I had to figure that out for myself. And I ended up going to law school and became a lawyer and practiced at two of Canada's most prestigious institutions in corporate law. My practice specialized in mergers and acquisitions, corporate finance, corporate governance. And then I actually took a bit of a turn and got into sell side investment banking. So working with the selling business owners and helping them sell their business. And then we would hand the file over to the lawyers, which was my previous job, and really got a full understanding of how the M&A process works. After some personal time to reflect, I decided that I missed practicing law and wanted to get back into it. And so I'm starting up my own firm so that I can provide the help and support that I want to provide on the terms that I want to, which is supporting entrepreneurs and the people who are actually contributing to our economy and investing in it. Yeah, thanks for having me here.
Pleasure. So, we got connected, I think originally online. No, I think it was Sam Lichman who connected us. And it was specifically around, I think it was the work on, uh, oh God, employee
It was
ownership.
Zale Moransky who connected
Yeah,
us. We don't
Morantz.
want Zale to be mad at us.
Okay.
It was
Oh,
Zale.
no, sorry. Zale was Zale. So Zale connected us around the work that had been done in employee ownership trust. And I've covered that in a couple of episodes
Mhm.
for this. But today we're going to talk about a different topic that you've had a bunch of experience around, and that sounds very sexy to many, but has good and bad trade-offs too. And that's the concept of private equity. Okay.
Mhm.
Private equity, what is it? It's these large pools of of capital, whether they're sourced through small investors or through large institutions, that go out and basically make large investments or buy out firms entirely in order to turn a private business involved, to basically take that private business and unlock value somehow. So let's talk about that. Let's talk about what the motivations are, and then we'll get into the good and the bad and the realities of it.
Sure. First and foremost, there's different segments of private equity.
Mhm.
So for someone that doesn't know what private equity is actually a sweeping term. And there are different segments that operate in different ways. So it's important to understand where the company is on the company life cycle. So there's private equity firms that are, venture investors that have a really good idea and they put money into the business to get that idea flushed out and, ready to take to market. Then there's growth investors that see a really good business, say, operating in Canada, and they want to take it to other markets and really grow that business. And then there's buyout private equity, which is the one I'm the least fan of, where they find mature businesses that are really doing well, but really require a big investment to take that growth to the next level. The business is mature and really is in need of reinvigoration. But often, a lot of that investment is not to grow these companies, but to take the value that they have and extract from it. And these are the predominant buyers of Canadian businesses in Canada. They're called buyout because they buy out the entire company. Whereas the earlier stages of private equity, they're typically finding a co-founder or founder, sorry, that they love and they love the passion and spirit behind them and injecting money into them to follow their vision. The buyout firms try and find retiring business owners or frankly, businesses that have already been owned by private equity firms, and take the assets that they have, the cash flow that they have, and redistribute it back to investors.
Well, yeah,
And
I mean, just to interject here. I mean, like you're basically, you're talking about the life cycle, and you just described effectively like private, you talked about venture capital early on, right? So venture
Mhm.
capital seeds things early on. I've had episodes on venture capital in the past. And, here's the thing. All of these companies, whether it's venture capital or mezzanine financing in the middle, or whether it be the buyouts at the end, they're all looking for the same thing, a return. They're just doing it in
Sure.
different ways, right? And that's fair. But, there's the extraction. I think I'm going to correct you a little bit. The extraction of return is not a bad thing. What you do to the underlying company might be a bad thing in light of that. I mean, we've seen, unfortunately, recent failures of the likes of the Bay, right, which was, bought out by private equity, restructured, saddled with a bunch of debt, and then just could not maintain anymore.
Yeah.
And we've seen this happen over and over again with a lot of storied franchises across North America, where, the private equity firm will go in, see a lot of value in the real estate, carve that off, leave a business that's basically maybe struggling to pay those rents now, load them up with debt, and then spin them off while maintaining the crown jewels. It can
Mhm.
happen, unfortunately.
Yeah. So we're seeing a lot of this in the market, and the buyout funds are the majority of the sector. So
Mhm.
over 50, I think it's, I don't want to be quoted on this stat, but it's, I think around 55% of the sector is buyout versus the more investment
Yeah, but that
oriented
also makes
segment.
sense because they're going to mature businesses, which have higher values. So you need bigger checks to cut, right? So it makes sense that that's where the money would be.
Well, I want to bigger checks to cut is a great part to interrupt you because when people think, okay, a business is for sale for $100 million, what's that check you're going to cut? And, a normal person would think $100 million, and that's not true. So the leveraged buyout is a integral part of the private equity playbook where the asset that they're buying, the business, is actually the one paying for that purchase price. So the private equity firm will put down, let's say 10, 20% of their investors' money, and the balance is actually paid through the operating business that they're acquiring. So when we would do acquisition financings for deals like this, you would have the lender working with the buyer and the seller to get all the loan docs in place, that everything would happen simultaneously in one phone call where the money would flow, and the company that's being bought immediately after it's bought is sending 80% of the purchase price back to the seller. And so that money isn't even touching the hands of the buyer. It's going straight out of from a loan in the name of the purchase company back to the sellers. And
It's
so
funny
that,
in corporate finance classes. I remember this in particular. We were talking about optimal funding, like optimal leverage ratios within businesses, publicly
yeah,
traded or otherwise. And part of the reasoning around the publicly traded one was like, look, if you can achieve, I mean, don't get me wrong, if you can borrow cheap capital and you can invest and earn a greater return on behalf of shareholders, as a business operator, as a CEO, you have an obligation to do what's right to scale up the business
mhm,
in a certain way. And if you're under leveraged, then frankly, you're opening up the door for potential takeouts using your own ability to effectively borrow off of your assets, right? So if you don't, in a cutthroat publicly traded world, it is possible for PE firms to come in, see that opportunity, buy them out, and just basically use their own assets to effectively buy them out. Whereas, in the private world, you don't get hand forced that way. But
no,
effectively, in a lot of ways, the same thing. In a lot of small, let's call it more traditional business thinking, usually you see, a lot of business owners try to avoid that, right? There's just this is the denial that they don't want to leverage up their business. They hate that, whatever purpose. Just it's ingrained in us. So oftentimes the funny thing about this to me is that they could have extracted that wealth themselves over time by way of borrowing it, but they've chosen not to. Right now, of course, there's tax plays involved here and other
mhm,
other aspects of it. But it's like you realize this money could have been yours in the first place without you having to sell.
yeah, and that's not a bad thing when it can be serviced. It is
Absolutely.
not. It's not a bad thing at all. We all, people have mortgages, and you look at some of the biggest companies on Bay Street, private or public, they're all using debt. Everyone knows is cheaper than equity. But the problem lies in encumbering cash flow to subsidize the shareholders. And so, what does that mean? That means that when a business is acquired, they're financially modeling to figure out how much of an interest payment and a principal repayment can this business withstand.
Mhm.
And what that does is that opportunity cost of that debt is an investment in the economy. So if that business let's pull a number out of thin air here. If a business is paying $10,000 a month in debt repayment, if the business has a shock to its system, like a trade war, that's $10,000 a month that business doesn't have to protect itself. That's $10,000 a month that business doesn't have to raise wages or buy CapEx. And that money is going to shareholders. So that means that the business has the burden, but not the benefit of that. So if that loan were to be used to buy machinery, that would translate into increased productivity. And now owner debt isn't a bad thing in and of itself. You said it. Dividend recapitalizations are a great thing that in the past that have now been abused by the finance. So a dividend recapitalization is when a business takes out debt and directs it immediately back to the shareholders. So a dividend, we're used to coming out of profits, but this is a dividend from debt. And so where this is useful is if you have a family business and you need a bit of liquidity, or you want to frankly treat yourself because you've earned it. You've got a great company, but you don't want to have to sell shares in your business to enjoy some of the fruits of your labor, for sure. But it's not meant to be used en masse to extract value, to return returns to shareholders. It's meant.
In fairness, though, the tax code does reflect this difference. It doesn't qualify for lifetime capital gains exemption. It doesn't qualify for capital gains treatment. It is taxed at a higher rate, fully integrated. So, it's not like it's a free ride.
No, but it's a ride that's being used when transactions are down and liquidity for the liquidity demands are still there. So you've got pension funds that are invested in these buyout firms, and they need to pay the teachers. They need to pay the pensioner. But if you're not flipping companies, you don't have that cash to return back to investors. And so your only alternative is to load on more debt. And that makes
I think
these
there's a
companies.
clear differentiation here. There's a difference between the owner who created and runs the company on his own behalf, and then there's the investor class who has to get their pound of flesh, which is not a bad thing. They're putting the money in, but it's how you get that net result. And yes, the entire manipulation of debt to pay dividends as opposed to actual operations. If that debt, that's okay. If you're recapitalizing to a point you should be at, it's not a good thing if you're recapitalizing to a point where you're inhibiting the company's ability to continue to earn free cash flows in the future, right? So
Exactly.
else, too much debt is bad. And famously, these leveraged buyout firms use said upwards of like 80% debt in these cases. I mean, anyone who wants to read Barbarians at the Gate, it was a great read that gave you a pretty transparent view into how this works. But, and part of the argument they'll often say the debt it creates discipline. It creates discipline around the need to cut costs and create cash flow, all that other stuff. And there is some truth, but you don't have to be here. You don't have to be up to your nose in it to basically get discipline from debt, right? There is too much of a thing before you start endangering yourself.
Well, I think that's the exact difference between an entrepreneur and an investor operator. An entrepreneur doesn't run their business to maximum optimization. Some do. There are certain things that maybe don't have an ROI that are worth paying for, like a really nice Christmas party or, sponsoring a baseball team in the community. These are things that by virtue of owning a business, you have the pleasure to contribute to your community. But when you have to optimize your capital, it doesn't distinguish between something that's beneficial to humanity. And you have to do what pays back the best, regardless of what opportunities you're turning away and what the harms of the decisions you're making. And so that's why I love working with entrepreneurs, because they have that flexibility. They have the ability to contribute to the communities that they're operating.
But again, varying degrees of this, right? Like, don't get me wrong. There's also, businesses that are highly profitable that private equity can go into and imbue some discipline to get rid of some of this, the obvious fat or things that were just not working well. Right. And
Absolutely.
so lots of opportunities. Like some people just don't, some business owners don't want to go beyond a certain level of complexity. I know one local business here who's done a really great job in one segment of the economy, typically based around distribution of certain things for one cultural community. And they've resisted the urge to move outside their cultural community. And I know of their suppliers who are frustrated with this because they can't, they got contracts with these guys, but they're just out of their comfort zone. Or of course, the old problem of, nepotistic practices like, oh, I employ 12 members of the family who really don't actually do any work or whatever else it is. Or they just don't have the competence or the understanding to take that business to the next level, right? That a private equity firm with professional who understands the landscape and with a proper professional criteria and support can come in, put in proper management, clean the place up, make the thing basically be a better version of what it was and continue to grow. Absolutely. That is a possibility. But there is a law of diminishing returns to everything, right? And as I said on stage at Edge 2024 in Florida, it was, look, it's not the first PE firm that worries me. It's the second and third one, right? Because first one gets the obvious. The fifth one, yeah. The first one gets the obvious savings, right? They go in there and they fix the obvious things. The second one maybe sees the opportunity that was missed, right? And wants to do something strategic and say, we're going to take it into this jurisdiction. Fine. It's the later ones where it's like, okay, or going back in a lot of ways to Barbarians at the Gate, with Nabisco being the object or the one that we're going after. I mean, there was a lot of waste in that company. They had their own private fleet and everything else. But beyond that, it's like you look at that and say, like, where else was Nabisco going to go in terms of like distribution for its product worldwide, right? It's not like it was like, oh, we need to open up new markets. Sooner or later, you get to a point where it's just about cash flow extraction. It's, can we borrow this because it can carry all this debt? We can strip it to the bone. We can increase cash flows and just worry about paying out that debt, and then we'll flip it somewhere else after it looks clean again. And yeah, there is a problem there because you can't get blood from a stone. Sooner or later, you lose. There's no easy wins left anymore.
Like Red Lobster was a great example.
Oh my God, terrible.
Yes. And I hope to dispel all the myths that it wasn't the all-you-can-eat shrimp that bankrupted Red Lobster. That may have been the straw that broke the camel's back, but it was the sale-leasebacks and that heavy debt load. You see a lot of these retail businesses going bankrupt. Is the business model past its prime? Absolutely. But without, or, not absolutely, but there are a lot of struggling retail businesses out there. But if they didn't have these obscenely high debt loads, perhaps they would have the cash flow to be able to innovate, to make some changes. But when you've got these high debt burdens, I think Toys R Us in the US, when they went bankrupt, their interest payments were upwards of 90% of their cash flow. No business can sustain.
Well, I'm hearing about how Saks Fifth Avenue actually couldn't afford, if they didn't own the building, they couldn't afford the rent on their Fifth Avenue location. Like Saks would be off Fifth Avenue, right? And, you can argue that from a business standpoint, like, okay, they should probably move.
I actually read that lease. I was part of that transaction team.
That's
and I got to read that original lease on Saks Fifth Avenue, which was really cool. But agreed. And actually, what a lot of people also don't know is that these leases can be capitalized for the losses as marketing expenses. But the real estate plays a huge role in this. I live in Little Italy in Toronto, where the immigrant mentality and they all invested in their real estate. And that's why it's such a vibrant community, because there isn't a REIT maximizing the rent payments and, kicking out small business in favor of corporate tenants that are going to be far more reliable tenants. But a lot of people also forget that commerce is community. I got my hair cut today, and my hairdresser and I were talking about how I love coming to her because we talk about things. There's a relationship there. My butcher knows who I am. All the dry goods shops along College, that adds to my life. And when we financialize businesses, we correspondingly dehumanize them. And that's not meant to be like that they're robotic, but there isn't that balance of, hey, let's do something because it's fun and it adds value, but it might not pay back perfectly. Might be pretty good payback. It might
Yeah.
be an okay payback, but I'm doing this because I believe in it. And so in my experience, we're seeing a lot of people put their businesses up for sale. And frankly, private equity is one of the only buyers. And I can't fault people for
Yeah.
cashing out on something that they have worked so hard on and built something so big and so great. And someone's willing to pay them a lot of money for it.
Yeah.
Nobody
I mean,
can be faulted for
well, I
doing
mean, well, let's take a step back to some degree. Being in an industry with a succession crisis forever, okay? The reality is there is some fault, and that's not worrying about your exit, right? As a business owner, you're so busy worrying about
totally.
business that you don't think about your succession, right? Or you hope that maybe one day the kids are going to want it, and the kids grow up and they don't want it. But were the kids even the right option in the first place, right?
Mhm.
We're very successful business owners who very much think smart about this, and we got options for their exit. But they've also got internal management to the point where they're just basically slowly stepping back and eventually just going to sit on a board. And you know what? We're going to look at how they can sell this. And it may be an employee ownership trust. It may be a buyout from the senior leadership team who's been groomed to be in a position to do this in Compass. But the idea that you're going to build a business that is going to pay you, like we can have this small business on a corner farm. Let's just say a place that employs 50 people and, good size medium business that probably has a multi-million-dollar top line revenue number and pays, very good lifestyle, if not better than a lifestyle to the owner. To think that you're going to go at the 11th hour and say, I'm thinking of getting out in the next 3 to 5 years. Would you guys be interested in buying it? And just throw the question out when, are the people you're asking, first off, have they been empowered to understand how the business works? Do they basically have an entrepreneurial bone in their body? Sometimes they're just gonna be scared by that. Do they, where are they going to come up with the money? You haven't helped them answer that question, right? Like, yeah, like, and you look at these scenarios, and the funny thing is more often than not, a lot of these businesses, small business buyouts, have to take some form of, do some form of vendor take back, right? Where the
Mhm.
seller is the lender, and the lender, it's funny because they'll be like, well, I don't get it. Why am I selling this to just buy it back with my own money, right? For them to buy it with my money, right?
Mhm.
This is going to pay off this loan. Wait a minute, it's my business. So I'm paying myself. Yeah. The same thing happens with private equity, just that there's a demarcation point where suddenly you don't, you're getting it all in front, but there's this sitting on the debt, right? Like, so technically it's the same thing. It's just that you're not the bank, but the business is still paying off that loan. So if you have a problem with the business being
Yeah.
leveraged up, then you should have a problem you should never, if you don't have a problem with leveraging up, you shouldn't have a problem with the vendor take back.
Well, private equity is going to take a vendor take back, if not probably an
A lot,
earnout,
in a lot of cases.
which is fee for performance. So they want to make sure they're not overpaying. And
Yeah.
so your final payments are going to be contingent on
Yep.
company performance post
Absolutely.
closing. But I think you hit the nail on the head. Succession planning is everything. And us as lawyers, as brokers, as business advisors have not been doing enough to communicate to owners how to succession plan, because this is something you don't do in the 11th hour. You do it 10 years before you're willing to, ready to think about this stuff. Because what happens is you get to a broker, and a broker is just going to ship you off to whoever's going to max the payout as fast as possible. They want security of the deal, making sure that we can actually close this and that you're going to get paid as much as possible. That's their interest. But that doesn't always align with the motivations of the seller. What got me to where I am today was a deal I was doing as a broker. And this was a company that a union loved management. Employees loved management. This was a culture most businesses would be extremely jealous of. And we were going to sell it to, a pretty ruthless PE firm that was cold with us. So if they're going to be cold with us, imagine what they're going to be like when they take over. And I just wanted to say to them, this is not it. This is not what you want for your family legacy. And that's what got me here today, because there's so much education required And also, too, from a legal perspective, you can protect the interests that you want to protect. Now, that might be that certain buyers might not want to do a deal with you, but you can protect the interests of your employees post closing if that's important to you. You
Yeah.
can sell to your employees if that's important to you. But the key is understanding what options are available to you and doing the necessary planning and getting people on side. Because if you want to do an employee ownership trust, there's nothing worse than telling people, hey, we want to do an employee ownership trust, and then realizing this business is not right for an employee ownership trust, or they can't secure the financing because the business is not right for an employee ownership trust. So making informed decisions and knowing what are your lines you will not cross, because in the succession tsunami report done by the CFIB, business owners actually care more about the preservation of their legacy and their employees than maximizing the purchase price, like to get the most dollar. So it's
Yeah.
really important to know what your lines are and what's important to you before you go down the sale process.
And I've seen it and lived out to some degree. I remember I bought a practice years ago, and at one point, one of the partners was like, "Well, I'm pretty sure I can get more with from the guys down the street." I'm like, "Okay, great." And here's what that's going to mean for your clients. They're going to turn the book over to generate as much commission as possible or to pay you off as fast as possible. And he kind of stopped for a second. I go, "That what you want all your friends who are members of this working here or sorry clients here to have happen to them?" So the reality is that yeah, I can pay you more, but I would have to do unethical things in my mind in order to basically finance that. And I'm not going to do that. So you have to
Exactly.
accept that. And the second piece of this is that have known several people who have sold their business to either private equity or various private interests, only to see the business destroyed over time, its
Mhm.
reputation and shatters, or just shelved entirely. And you talk to these people, it's like their children got just killed in front of them. It is
Exactly. Like when I sell a business, it's like you're putting your child up for adoption. Like that's the seriousness I take this, because this is their life's work. That it's like a child. And so we want to make sure that it's not put in hands of someone you don't approve of, and that they're just telling you what you want to hear to get the deal done. It's important that you work with advisors that know how to ask the right questions and protect your interests so that when you're no longer in charge, you perhaps have the legal recourse through agreements to ensure your people are protected. Now, that can't exist in perpetuity. I worked on one transaction, a very notable one, where the seller said to the buyer, you got to maintain the factory and keep everyone employed. And the day that agreement ceased, the factory was shut down. So you can't get everything,
no.
but it's important to prioritize what's important to you, know what you're looking for in a buyer, because people will tell you what they want to hear. And it's very easy to get impressed with the razzle dazzle of a big private equity firm. And you know what? Some of them are great. And some of them are going to, put a lot of money into your business and grow it. But it's understanding who's in charge, what their previous portfolio companies have looked like. Get references.
Yeah.
I'd like to speak with some of your previous sellers and understand how happy they were with your business. That is a great thing to do, to understand previous past experience of those same portfolio managers and asking them how they've run their portfolio companies in the past.
But even with the good ones, it's a good idea to do that. I mean, like, even if you're like, wow, this company's got a great reputation, you still want to do that. Because here's one thing that I've also seen is that, because they'll typically maintain the owner has to stay on for a period of time afterwards,
Mhm.
and they have to make sure the transition happens. And I've seen many of them get frustrated at the fact that they've lost control, right? They've lost control. It's not the big things. Maybe they're okay with the big things, but they're not used to answering to someone or for the life of them reporting in on a monthly basis and having all the financials done every month to basically to just answer questions about things that were to their discretion but weren't part of the agreement. So like having an understanding for what the other side of that looks like even for them while they're there is an important conversation to have, because yeah,
Absolutely.
you're going to have a boss now, right? And you need to accept that, right? And that's just fair. That's what comes with the terms. So, yes, I mean, I think, going back to it, what I said earlier about succession, one piece of advice I always give is, I remember hearing a statistic in my industry where it's the average successful succession takes about 7 years, 5 to 7 years on average.
Wow.
Make the joke that failure happens a lot faster. And it makes perfect sense, right? For someone to come in and actually understand the business fully, the way that you need them to, start to finish, right down to the studs, and for you to work out the deal, and for you to do the transition period, right? That's not just a cold handoff in most cases. I always say to people, like, I just want to sell this thing and get out of here. I'm like, okay, if you really feel that way, you might not love your business, but also don't expect to get the top dollar for it, because this is all, every deal, as I've done a couple of episodes before this on this, is about basically the buyer and the seller not only negotiating price, but negotiating what risk gets kept by each of them, right?
That's
So
exactly it. That's exactly
you're right.
it.
And that's going to take time, right? That's going to take, I don't know, what's a reasonable amount of time you think people need to negotiate the sale of a business? What a question.
That's a great question. Um, Starting from like or I would say from finding a buyer that you want to partner with and diligencing them all the way to legal, 6 months.
Yeah. So 6 months.
4 to 6 months. Because it can get rushed.
Yeah.
And I think it's important to have time to think. I've been in crazy deals where I've gotten stuff done in record amounts of time, but you don't have time to sit and think and process. And this is arguably one of the biggest decisions you're going to make. I think you need that time to marinate with your thoughts. And is this the right partner? And also getting the right legal advice. You talked about how, people stay on post-closing as advisors. This is all highly negotiated stuff if you know what you're doing. So ensuring you have minimum or maximum commitments of time. When there's an earnout, I would never let a client have no control over the business and an earnout, because it would just be so easy for them to tank the business to not pay the earnout. So there's all these different elements that come into play. But, coming from big firms on Bay Street where it's go, 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 get the deal done, get the deal done. I think that works more for buyers than for sellers.
Yeah. But then, first, let's go back to 6 months. You're probably talking about the point where buyer's been identified, preliminary negotiations around price have happened, and now you're getting serious time to lawyer up,
Yeah.
right?
Yeah.
Like, so that's 6 months. The pursuit of the potential buyer, right? Like, even if it's, even
That's another 6 months.
that's another 6 months. You're talking a year to negotiate and get to signing realistically, as like realistic conservative number, right? Let's tack at least a year on for the transition period. Right now you're at 2. Then, especially if it's internal, you're not getting internal. You got to basically pitch this years in advance. It's something like, yes, we can talk about this, but you got to groom the person to the point that they can get there. So you're talking years prior. But let's just say minimum 3 years to get someone to a position like that. Now we just got to 5 pretty quickly, right? And you throw on an extra year for making it a 24-month transition period. Now you're at 6. So the entire number of, yes, we can a lawyer can get a deal done in a heck of a lot less than 7 years, but start to finish in terms of intent, ideation, and completion and walk away. Yeah, we're talking a lot longer than that. We're talking
absolutely. And there's some businesses that aren't ready for sale. So you can come to the decision and you say, okay, I'm ready to sell. And then you realize everyone on the management team is 65 and retiring. That's not a sellable business, or at least you're not going to get good value for that business. Because the distinction, especially with private equity, is they're above the operating company. So they don't run the business. They need your team to run the business. And so I love working with exit planners. It's a new distinction. Not a lot of people know about it. But these are certified professionals that are there to help you prepare your business for sale. They're not going to help you sell your business, but they're going to help you figure out what your weak points are so that you can close your gaps, so that when you are ready to sell, people are going to take you more seriously. Because there's, For every business we take to market, you think about it as, you throw 100, 200 leads out, you get 10 expressions of interest, you get maybe one or two LOIs, and you pick one suitor. So, you start from this huge pool of people and you whittle your way down, and you may not even be able to get a deal done
Yeah.
going to that many people. There are a lot of times where the deal just doesn't happen because there's some gating item that's too much risk for these buyers to assume. So it's really important to know what your weaknesses are. So if you have a contract with, say, one of your biggest customers that's coming due, get it redone before you take your business to market. I had an amazing company that I was trying to sell that was getting kicked out of their lease, and they had nowhere to go. These are things that you need to shore up. If you're at the end of your lease, get a new facility before we put you up for sale, because that's a big thing that's going to heavily discount your price. And frankly, even if you're paying a little bit more rent in a new facility, you're going to normalize out all your moving costs. So that's not going to factor into your purchase price. But the risk of not having a business is going to impact, or not having a facility, especially a manufacturing business,
Mhm.
that is going to impact your purchase price far more than paying a little bit more rent than you would in your older facility.
Yeah. And that's the one thing about this process that everybody's to come to terms with is that guess what? Your baby ain't as pretty as you thought it was. Everyone thinks their baby's beautiful, but when it comes under scrutiny, there's all kinds of things that have to be adjusted and fixed before you do it. And, again, I think we spent a lot of time in particular talking about investor buyers, right?
Mm-hmm.
There's another category that I coach people on all the time that you kind of touched upon, which is a strategic buyer. Well, someone who comes
Yeah.
in as they're in the same sector or an adjacent one, and they can operate your business. They already know, have that expertise. They basically could just technically buy out your client list and your inventory and just add it to their own and
Mm-hmm.
not skip a beat, right? So those ones, I always say, like, if you're looking to sell and you want to get top dollar, those are the ones that often can pay top dollar because to them, especially if depending on how much capacity they have, if they have capacity to just take on your clients and do your work with next to no friction, that's the most valuable asset that they're the most valuable buyers out there. Unfortunately, of course, that often means selling to competition, which people don't necessarily like, or it means
Mm-hmm.
competition know that you're potentially, up for
That's an
sale,
issue.
which,
Yeah.
blood, water, and people start going after your clients. So there's a bunch of strategic issues to worry about there in terms of how you handle that. And sometimes it's just not an option. Sometimes you're the only game in town in that area, right? So maybe there's an adjacent strategic buyer. The bottom line is there are options. So we've
There's
covered a
one
lot.
more option I just want to interject, which is a new one that doesn't get talked enough about, and I am a huge champion for, which is entrepreneurship through acquisition. And so you're seeing influencers like Cody Sanchez talking about, going out and buying a regular business. I had someone reach out to me from the United States. He bought a porta potty business. Not very glamorous, but you know what? It's making him
Basically buy 'em.
good money. It's making him good money. And there are existing sources of capital through BDC and banks and business advisors that can help you do that. If you've run somebody else's business for them and you know that you can do it, go do it. You will be amazed at how much more control and capital you have in your pocket when you own your own business. Look at me and starting up my own law firm. When I did the math to figure out how much more money I could make by doing it myself, it wasn't even a question. Of course, I'm going to do it. And so, getting people to know that if you want to own your own business, you don't have to start from scratch. You can go find something out there that's up for sale. The issue is finding the sellers. And so this is something connecting these buyers and sellers, because these networks don't exist. And it's very hard to connect these parties. And so I'm working on creating these networks so that there are more conversations. Because I am a firm believer that owner operators and entrepreneurs are the ones who contribute the most to our economy. And so if we are selling businesses from retired owners to new aspiring entrepreneurs, I honestly think that this is the best thing we can be doing for the Canadian economy.
So before we wrap up, where can people find you?
People can find me on LinkedIn. I like to post my thoughts on LinkedIn. So please give me a follow there. And I will be launching my website pretty soon, wassermanbusinesslaw.ca.
Rachel, thank you for taking the time.
Thanks for having me.
So that was this week's episode of Financial Plan for Canadian Business Owners. If you enjoyed that, please leave a review wherever you your podcast, or if you're watching on YouTube, like and subscribe. Thanks. Take care.